Hi, everyone. Jim Cruzan here, and welcome to a really quick end of November summary. Hoping to provide some information to you on kind of what happened during the month, generally how the markets performed, and what some of the data that we're looking at presented. So let's get into it. As I've said for quite a while now, we're looking at data. We're somewhat data dependent beyond just which way is the market going. We will follow this data to whatever its conclusion is. Either the data continues to dissipate and weaken until we see a drop and a recession. That's typically how most recessions occur. We saw the same thing in '01. We saw the same thing in '08. Market continued to go higher. Data continued to decay until the bottom dropped out, and then everybody was surprised. Or the data may start to show signs of improvement. And that would be improvement with credit cards and creditors, and improvement within mortgages, and improvement within leading economic indicators or whatever. It would look like a Nike swoosh. In addition, we also said, hey, this highly concentrated market of Magnificent Seven is not a really healthy environment. It kind of biases one's views on the market. And we should see a broadening out. And quite frankly, we have. The market has been broadening out since about mid-year, July or so. And most of the return that we've had in one of our IRA models has been primarily all since the second half of the year, since this broadening out. Now, the concern is this broadening out because better days are ahead and the market is sensing a soft landing, which we're not seeing yet in the data? Or is it a broadening out because of FOMO? A lot of folks sitting on the sidelines waiting for this recession that appears to never come. They're frustrated. They want to get back in, but they're hesitant about chasing big tech. So they buy the things that haven't moved. We don't know. All we know is there has been some degree of broadening out. As far as the LEI, this was produced just before Thanksgiving, just last week. And once again, it dropped for the month of October, 0.4%. And that drop was on top of the drop the month before, on top of the drop the month before, et cetera. In fact, 23 of the last 24 months, I think it's something like 29 of the last 30, the LEI continues to weaken. More on that in a moment. This is certainly a cautionary tale, as every large drop we've seen has coincided eventually with a recession. Even the Great Recession, as bad as it was, we saw the LEI drop for a good 2.5 years before the inevitable happened. As far as the yield curve, it is no longer what I would consider inverted. It's somewhat flat. And we can see that by the blue line here. Short-term rates, the 1 month, approximately the same as the 20-year, quite flat. We can look at where things were a year ago by looking at the dark gray line beneath, and you'll see that it's more inverted. Short-term rates are higher than long-term. So since then, and certainly since the beginning of July or so, we've seen short-term rates come down. The Fed's cut rates twice. And at the same time, long-term rates are going up to flatten this thing out. Now, flattening this thing out doesn't necessarily mean return to normal. Everything is terrific. As we've seen, inverted yield curves are highly predictive of recessions. The blue line represents the spread. Anything above the red line is a normal, healthy, upward trending yield curve, which happens nearly all the time. On rare occasion, the blue line is below red, which is an inversion or inverted yield curve. And we'll see we break below the red line. The yield curve inverts. It stays inverted. It then breaks above the red line, going back to neutral or normal. And that's when the recession happens upon us. And we're right there at kind of break even, we're very flat. SOM rule, which measures the rate of change in unemployment, broke through and violated the SOM rule several months ago. It's still quite elevated. Anytime the spread has gotten to 0.5% or greater, we're usually in the midst or at least the outer edge of a recessionary period. The employment factor is can be a bit misleading. The numbers tend to be wonky and prone to large revisions. I wouldn't put nearly as much weight in that as the prior two indicators. Another indicator that has become popular in the media the last 30 days or so has been this Buffett indicator. And there's certainly been a lot of comments on Buffett to the extent of him indicating he's been selling, increasing cash positions. His cash hoard now exceeds, I think, $400 billion, highest ever. And he's used this indicator at 30,000 feet to determine whether the market's sensical or not, whether it is in some type of a bubble. And he's made reference to this several times before, just before the 01 recession, and again in 08, before the 08 recession. And he's now making comments regarding it once again. What this does is it gives you a sense for value versus productivity. Looking at the total market value of the U.S. stock market, publicly traded companies, we use the U.S. total stock market index, the Wilshire 5000, and what its value is, and we compare that to GDP, which is the sum total of all productive nature of the U.S. economy, both publicly traded and private. So when we measure just the market's view, publicly traded stocks against this productive measure, it gives a sense for how much of a bubble we may be in. Right now, the index is 208. It's the highest rating ever measured. And we can see from this chart, going all the way back to 1950, how this has peaked to only then show a large drawdown. If you look at the historical trend line and where we are today, we're incredibly above the trend line. He indicated issues back in the early 1970s before several large drawdowns. He mentioned problems with this in 1999, just before the 2000-2001 reversal, when valuations were 2 standard deviations removed from norm. And now today we're again 2 standard deviations removed. So we have this undercurrent of cautious economic macro data and a market that's priced to perfection. In addition to the macro data, we're beginning to see some other more frequently published data that's suggesting some stresses and strains. The LEI that I mentioned, which dropped again, if we did a measurement of the last 6 months compared to the prior 6 months, it would indicate that the last 6 months, it's actually fallen a bit greater. The slope is even more negative. Not what you'd expect if, in fact, this is a soft landing and better days ahead. If we look at the credit card delinquencies, 90 days or more, people who haven't made a payment in over a quarter of the year, it's over 11%. Put that in perspective, that's 1 out of every 9 cards. It was just 9.4% a year ago. And we haven't seen it this bad since coming out of the Great Recession 2010. And for a better part of 2 years, a lot of folks have been talking about commercial mortgages on office buildings, the problem that these things roll over about every 5 years. They're coming off of a period where mortgage rates were maybe 3 because the 10-year treasury was 6/7 of a percent. And now they're rolling out into 8-9% rates, and they don't have the collateral because the buildings are now nearly empty as opposed to full. That delinquency rate is now 10.4%. It spiked a full percentage point both in November and also in October. It's the highest now since the recession. And again, both of those data points, we're in a period where everybody says economy is solid and great, nothing to worry about. Yet we have these issues, which are certainly problematic and reminiscent of much harder times. Also, this data point has now more than doubled since last summer. Manufacturing is tough. We're seeing a lot of numbers that indicate contraction. The ISM contracted again, 24th time in the last 25 months. The Philadelphia Manufacturing Survey, which is published by the Federal Reserve Bank of Philadelphia, it was 10.3. It's a different scale. They were expecting 8, which is a bit of a pullback. It came in at a minus 5.5, big drop. Some of that might have been because of both the strike and the dock strike, as well as Boeing. We'll see. Chicago Business Barometer dropped to 40 from 41, and the month prior it was 46. 50 or less is contraction. So it's not only contracting, but contracting at a faster rate. I won't spend a lot of time on this. Employment, jobs, really quite wonky. We're not sure whether the jobs numbers, full-time or part-time, hours work continues to diminish. What we're seeing is, for the most part, corporations hesitant to lay off. Those who are laid off are having a tough time finding work, but we're not sure if full-time jobs are getting traded for part-time. So I would be less willing to put a lot of data in, or a lot of faith in this data, at least at this point. As far as November, it was a positive month. The S&P was up over 5. Equally weighted S&P was up almost 6.5. The Dow Jones was up over 7, almost 8. The NASDAQ 100, which is mega cap, was up a little over 5, whereas the composite, which is a bit broader, was up over 6, and the Russell was over 11. International markets were down. The dollar rose compared to the euro, and gold, because of that, dropped. So you would expect gold international down if the dollar is essentially rising. U.S. Treasuries were also down essentially for the month. A balanced account, 60-40, all U.S. securities, large cap and ag, up about 3.7. Some component of global, 40% U.S., 20% international, was only up about 2.5. And one of the models that we use here for a lot of our more conservative IRAs, Dynamic Global, was up just under 3.9. We saw a broadening out, as you can see by these numbers, and we participated in that. Within the broadening out theme, we're seeing less control of the Magnificent Seven. The Magnificent Seven stocks are listed here. Their monthly return is also listed, as is their weighting within the S&P. Next to it is the weighted return. So essentially those 7, which represent 31.35% of the S&P, the top 10 represent over 35% of the S&P. During the absolute peak of the dot-com bubble heyday, the top 10 represented about 28%. So you can see where this has gotten stretched since the last time we were in this valuation bubble. Needless to say, those 7 produced a return of 2%. 2% against the 5.9 is about 34% or so. So 31% of the S&P produced about 34% of the performance. That's a whole lot more in line. For about a year and a half, it looked entirely different, where those seven produced 100%, 110, 115% of the S&P's return on a monthly basis. So that's what happened in November. We'll be back to you in December for a review of the quarter. Until then, have yourself a safe holiday season. Enjoy the family. If you have any questions or would like to make any comments, please reach out either by phone or you can reach us at kaydanwealth.com. Thank you so much for your support and confidence, and we'll talk to you again real soon. Take care. Have a great day.